Welcome, everyone. Thank you for coming. I am a little bit sick, so I'm glad the microphone is here. It's not beers from yesterday. This has been persisting for a while. Anyway, I'm here to present joint work with Sean Foley, who's actually also here, and Jerry Sveck. My name is Anne. We're all from the University of Sydney, very far away. Anyway, so this paper asks this simple question: how investable is Bitcoin actually? So, everyone here has probably seen this graph. It's the price of Bitcoin over the past year. So, what it shows is that even though, well, there's been a lot of trading going on and the price going all the way up to $20,000. But the thing is that even though that there's so much trading going on, there's so much media attention, there's so many businesses, as we've seen over the past couple of days, starting to get into this market. There's fundamental statistics that we don't know about these markets, like how costly is it actually to trade here? How much liquidity is available? How much depth is available? And we don't know this because I can't just go to Bloomberg or Thomson Reuters Tick History and download high-frequency data and estimate spreads, for example. So that is essentially what we've been able to do on our own by collecting data ourselves. So what we do in this paper is we show trading statistics of 3 major American exchanges. We show the transaction costs that you will incur when you trade on these exchanges. We also show the depth levels, and we show how this liquidity varies within the day, but also over our time period. Then we move on and look at, well, what is the trading behavior that is being facilitated by these structures on these exchanges, and how does changes to the market structures change the trading behavior, but also the overall market quality. So we're doing sort of 2 different things in this paper. First, sort of describing, well, what is the liquidity like, and how does it change the market and the trading behavior change whenever the structure is changed. So we can do this because we've been cooperating with the Capital Markets Cooperative Research Center in Sydney. And we've been collecting high-frequency trading quote data from the APIs directly from the exchanges. So what we do is that we poll the exchanges twice a second, which then creates this high-frequency trading quote data set. We've been polling Gemini, GDAX, and Kraken in America, 3 major American exchanges. We started on August 1st, but because Kraken implemented a tick size change, this first part of the analysis starts on September 7th. And I reran everything on May 10th, but I can extend this as time passes, which is always nice. And then we look at Bitcoin to the US dollar just to get an overall indication of the liquidity of the most liquid, arguably, currency pair on these exchanges. So what do we find? Well, these exchanges all have different fiat currency pairs, they have different cryptocurrency pairs, they all have some sort of discounts either to liquidity providers or volume discounts, and these are all explicit fees on their websites. They have different tick sizes that vary between 1 cent and 10 cents, but because of the price of Bitcoin is so high, the relative tick size is teeny tiny. What we find is that daily, there's between 11,000 and 36,000 trades on these exchanges on average. The price is around $9,000 across our time period. But as you can see in the graph before as well, it varies quite a lot over the time period. The average volume is between half and a whole Bitcoin. But as you can see, the minimum volume that you can quote is actually really small. It goes down to 10 decimal places. When it comes to transaction cost, the quoted spread, which is essentially just the difference between the best bid and the best ask, time weighted, varies between 0.5 basis point and 7 basis points. The effective spread, which takes into account the average price of the trade, and is a more correct measure of the actual trading cost that you'll experience, varies between 5 basis points and up to 22 basis points. To put this into context, this is lower than both the New York Stock Exchange, Euronext, and the LSE. So compared to equity markets, these transaction costs are actually relatively low. Depth varies quite a lot as well across the exchanges. Yes. So how does this vary within the day? Well, this is all American exchanges, so this is all in American time. And it has been standardized around 100, so the average is 100%. And what we can see, I have my little pointer here, is that when people are sleeping, there's not a lot of transaction activity or trading activity going on. Then as people get up in the morning, transaction activity or trading activity starts increasing, and it peaks right around when the New York Stock Exchange opens. It then sort of decreases throughout the day and then falls off a cliff when people go to bed. So even though that this is a 24-hour market, you can trade whenever you want, people are clearly not. And this indicates that these are not algorithmic traders. This is not bots doing this all the time. These are people who actually get up in the morning and start trading. These are retail investors. This pattern is fairly similar to what we see in foreign exchange markets that also have this variation within the day, but it is distinctly different from equity markets that has this opening and closing effect with increased trading activity at opening and close. One interesting thing is that this pattern actually persists throughout the weekend. So in foreign exchange markets, we don't usually see a lot of variation within the day over the weekend because people don't really trade then. But we do see that here. When it comes to volatility, it follows a similar shape, but it's less pronounced. It also has a positive correlation coefficient with trading activity. When it comes to spread, we plotted out quoted spread as well. It's negatively correlated with trades and follows sort of the opposite pattern. And it's also negatively correlated with volatility. So what this sort of indicates is that because volatility increases when trading activity increases, this would indicate that most of these traders are uninformed, because uninformed investors are willing to trade at a wider range of prices than informed investors are. And you could argue that here, well, practically everyone is going to be uninformed, right? There's no fundamental value of this asset. However, when it comes to the quoted spread, this is on average, of course, within the day. But throughout our time period, the quoted spread varies quite a lot. So when we saw the big increase in price in December, the quoted spread also increases, but in particular, the effective spread. So the actual cost that you'll be incurring increases as well when there's a lot of trading activity going on and a lot of this hype that we've been seeing. So, yeah?
The spread is pretty small compared to the New York Stock Exchange, but I think it's an unfair comparison because you should compare first with liquid stocks, and second better with FX. And there, euro-dollar is 1 to 2.
All right, so then it would be sort of comparable then. Well, then it's even a, yeah, sure. Yeah, so if we, so what you say is that if foreign exchange markets only a couple of basis points in trading cost, this is actually quite expensive. That would be. Yes. Yes.
You need to make some form of adjustment to the difference in the size of the markets.
Yeah. No, I'm not saying that like they're the same markets at all. It's just to put it into context, really, so that I have these guys in here. Anyway, thank you for the comments. All right. So what we essentially show here with the descriptive statistics is that it's actually quite investable, in particular for retail investors, because they're low implicit cost and there's adequate depth for the average trade. And this becomes interesting whenever we think about this as a global market. You can trade Bitcoin wherever, right? So these intraday variations would imply that if we looked at European exchanges, you would see a similar variation. So it would be interesting to see, well, what if we aggregate across globally? Would one intraday pattern start when the other one stops, which means that globally there would be no pattern. So this would be an interesting extension of this data, or of this analysis when we get more data as well. So this is all for the average size trade though. As soon as we go to larger trades, you will experience a lot higher transaction cost. So if we look at the dollar volume of a trade and then the effective spread, you can see that there's a positive relationship between the two. And in particular, if we zoom in, the relationship between the dollar volume and the effective spread goes out, right? So why is this? Why is it that it becomes really expensive to trade when you trade large dollar volume amounts? Well, as we saw previously, this is a market with extremely small tick sizes, which means that you only have to price improve by a small amount to get execution priority. Combined with small lot sizes, you don't actually have to quote a large amount to gain, or with your, you don't have to quote a large volume with your quote to gain execution or to gain priority. And what this leads to is this undercutting behavior, or what we call undercutting, where you jump the queue by improving the price, and because the tick size is small, you can do this at low costs, which creates this really intense price competition within the order book, while you'll be constantly undercut by new orders coming in. So if you post a larger order, then people will free ride off of the information within your order, undercut your order, and get executed before you do. What this leads to is really shallow books. So at any given time, the best prices might actually not have a lot of volume attached to them, even though on average, it facilitates sort of the average size trade. In addition, this leads to unconstrained spreads. So when I say unconstrained, it's the amount of time that the spread is equal to one tick. That doesn't happen very often on these exchanges because the tick sizes are so small. So we see these, so time priority becomes ineffective because it doesn't really matter when you posted your quote, because people can always just undercut your quote. It's going to be all about price. That's what you're going to be competing on to gain execution priority. And what this then leads to is these extreme effective spreads when you trade large amounts, because you'll be walking the book, you'll walk through multiple price levels and get a worse average price of your trade. This increases implementation shortfall as well, because you might decide to trade based on the best prices in the book, but your average price is going to be worse than that because the book is fairly shallow, right? So what we can do with this is actually quite interesting, because this situation is distinctly different from any other market, really. We haven't really been able to look at, well, what happens when tick sizes gets this small? Well, we can actually test some of the theoretical literature within tick sizes. So there are a couple of papers who've argued that when undercutting is prevalent, when tick sizes are small and this activity is really common, then people start moving from limit orders to market orders. They're essentially too impatient. They don't want to just sit there and have to constantly resubmit their orders. They'll just eat the spread and cross the spread and use a market order instead, right? So what they find is that in particular for illiquid books, small tick sizes leads to wide spreads, decreased depth, and there's probability of execution being decreased as well because of undercutting, yeah? Huh? It depends on the exchange. Some give discounts to liquidity providers. Gemini doesn't, for example, where it's free on GDAX to provide liquidity. But that's one of the things that they're trying to do to encourage liquidity provision. What they also find is that you will see higher trading volume because people now start using market orders instead, but then you'll also incur higher trading costs. So there's another paper as well that looks at, well, this tick size actually has a spread improvement effect. Usually we think about tick sizes as being a constraint. It forces the spread to be wide, right? That's often also true in equity markets. But when tick sizes are so small, it can actually force the spreads to be wide as well, because you only want to improve the spread if you're impatient, if you have high waiting costs, and if you can't just sit around and wait for a market order to arrive. So what they show is that when tick sizes are small, the bid and the ask will actually move towards the most extreme points that they can, and it can become difficult to improve the spread. And combining this literature, it actually shows that, well, if people start using market orders instead, well, then this order arrival rate will start increasing, right? I can just sit at uncompetitive prices with my limit order and still get executed because people will start using market orders instead. So I have no incentive to improve my prices and narrow in the spread. So this is what we're able to find empirical evidence for using this market, using Kraken as an example, as an experiment. We show that when tick sizes are extremely small, spreads are unconstrained and wide, transaction costs for large trades are quite large, and this undercutting is quite prevalent, well, then a larger tick size can actually lead to more liquidity provision and better market quality. So how do we do this? Well, we use 2 natural experiments on Kraken. So here you can see that Kraken's, the absolute tick size is really small. It goes down to 8 decimal places on some cases. Well, Kraken announced that they would want to combat some of this undercutting behavior that they've been observing as well on their market. So they're going to increase the tick size. So they did that on August 30th and September 6th. So we essentially go from a situation where the relative tick size is pretty much near 0 to being a couple of basis points after the tick size change. So this is what we can analyze to see, well, how is this liquidity providing behavior, how is undercutting affected and market quality affected whenever the tick size is increased under these circumstances. So we use data that's collected similarly as before. Now we only use the data a week before the first change and a week after the second. There's a week in between, so it's 3 weeks in total. Everything is calculated intraday in 15-minute time buckets, and we have 10 events because two of the currency pairs only changed once. So we have constructed some trading behavior metrics to look at, well, how is liquidity provision changed? And the first one is, well, how do we measure undercutting? Well, we look at how many times does the prices at the best, so the best prices in the book, how often do they change? Because if undercutting is very common, the best prices will not remain for a very long time. They will constantly flicker, right? We look at how many limit orders are being posted, what is the volume of those limit orders, and how many of these limit orders are actually being posted at the same price points. So when the tick sizes are really small and my cost of undercutting is really small as well, I have no incentives to stand second in line at one price point. So we don't really observe a lot of quotes at the same price points because I might as well just undercut them, right? So that's what we measure as well. And then we look at liquidity demanding behavior. So what is the volume of the market orders that we observe? How many price steps do they go through? Like how far do they walk the book? And when they do that, what is the different prices that they observe? What is the difference within the market order in price? We also measure some standard liquidity metrics to look at how overall market quality is affected. So we use a simple regression to do this. It has a post dummy in there that's equal to 1 after the change and 0 before. We control for currency pair fixed effects because it does vary within the currency pair. We control for intraday time, so we know what 15-minute bucket we're in. We also control for dollar volume, number of trades, volatility, and the average price. So what do we find? Yeah?
You also control for market depth on both sides.
Market depth? No, so depth is one of our dependent variables.
Everything
Yeah.
is endogenous. So I expect that when you have an dependent variable market depth, you control for that.
Yeah, well, we want to see how the tick size change affects market depth.
Yes,
Yeah,
yes. But both sides of the market depth is important.
yeah.
If you're a buyer, you would also look at the sell side, right?
Yeah, yeah, sure. But this is also total market depth. It's the sum dollar volume depth that we look at.
And not separate.
No, it's the total one. Right, so what do we find? Well, we find that the number of price changes, this undercutting behavior does decrease after the tick size is increased. We see more and larger limit orders and also larger market orders after the tick size increase. These market orders don't go through more price steps, so they don't walk the book more than before. But when they do it now, because the tick size is wider or larger, then the difference between the price steps is wider, so the price difference will become larger. And we do observe more limit orders being posted at the same price point. So all of this would indicate that there's more liquidity providing behavior after the tick size increase. When it comes to overall liquidity, we have measured quoted spread, effective spread, and realized spread, where realized spread takes into account the price impact of the order, and we can look at realized spread as measuring the profits retained by the liquidity provider. All three spreads decrease between 6 and 8 basis points after the tick size increase, supporting this theory that the tick size has a spread improvement effect. We also looked at level 3 quoted spread because of this undercutting behavior. Well, the quoted spread at the best prices is probably going to undervalue or undermeasure the true quoted spread, because not a lot of volume is necessarily quoted at those prices. However, the level 3 quota spread does not change, so it seems like it's only the best prices that are becoming more competitive after the tick size change. Spreads do become more constrained, so the percentage of time that the spread is equal to 1 tick does increase after the tick size increase, which is expected, but they largely remain unconstrained, however, after the tick size increase. Depth at the best, so the total dollar volume depth increases after the tick size increase. However, lower level depth, so this measure sums the dollar volume at X basis points on either side of the midpoint. Lower level depth remains the same, so it's the same dollar volume that is just being squeezed into the best prices. And then we also observe lower short-term volatility, in part because there's now improved depth, but also because of the less undercutting. So, in essence, what we show is that, well, when tick sizes are really small, undercutting is prevalent, and we have unconstrained spreads, then a larger tick size can not only improve liquidity provision, also liquidity demand. It will lower transaction costs, improve depth, and lower volatility. So what this implies is that spreads become wide when the tick size is really small, then start to narrow as tick sizes increase, and then have some sort of optimum of tick sizes, optimum of spread of the tick size, and then the tick size might become constrained again, which was what we see in equity markets, or become constraining. This becomes interesting whenever we start talking about order-driven markets, because liquidity provision is all we have, right? We have to encourage people to expose their orders, their willingness to trade. So this becomes important whenever we start discussing reducing tick sizes. Well, how does that actually affect liquidity provision? It might also have implication for global foreign exchange markets, which are sort of similar. And it adds to this discussion that we've had since the Securities and Exchange Commission announced that they would be increasing the tick size for small cap stocks to improve the trading among those stocks and improve IPOs. And of course, this is important for any cryptocurrency exchange who would want to see how does the market structure actually affect the quality of the market. That is all I have. Oh, wait, I'm concluding again. So what we asked, well, how investable is Bitcoin? Well, it's fairly investable for small trades. For retail investors, it's absolutely fine. It's as soon as you want to trade large amounts that you can incur quite high transaction costs. And actually increasing the tick size is one of the things that can try and mitigate this increased transaction cost exposed to large orders. So that is all I have. Yeah, I'm doing fairly good. Anyway, thank you for coming, and if you have any questions, let me know. Thanks. Yeah. Oh.
Thank you very much, Dan. Yeah, do we have questions in the room? Angela?
So, nice presentation, but that is pretty surprising because it's in contrast with the evidence we have in the stock market, for instance, the decimalization.
Yes.
The other way around.
Yes.
So, is it your story about incentivizing liquidity provision?
Well, the story is I've left out a whole bunch of literature because I didn't want to bore you guys. But you're exactly right. We usually see the opposite effect in equity markets. But the thing is, in equity markets, they don't have so small tick sizes like we observe here. And there is a paper looking at Euronext that has similarly small tick sizes. And what they propose is that when tick sizes are really small, then spreads will be wide, and increasing the tick size will decrease the spreads. So there's some sort of like concave relationship between tick sizes and spreads. And that is essentially what we find evidence for, is that beginning of the curve where the spreads are really wide and the tick sizes are small. The spreads will then start to narrow as you increase the spreads. Oh, as you increase the tick size, sorry, yeah.
I think there's also a relationship to the type of traders you have at the moment, because institutions trading large blocks of equities get very good deals from big investment banks. And small guys trading their, small people trading their own portfolio don't get such good deals.
Yeah.
This is not really an institutional market.
Yeah, no, it's not. Like we don't know. That's the honest answer, because we don't know who is trading what. But we can only assume, given that there's not really a lot of regulation, and also that this intraday variation persists over the weekend, would also imply that there's not a lot of institutional investors, because they would wipe out or have a different trading behavior. Yeah.
So there's a strong element of the relationship between the investor and the intermediary.
Yeah.
That determines the deal that the investor gets.
Yes. Yes.
Do we have any more questions in the room? Yes? No, okay, sorry. All right, then let's just quickly thank Anne again for her excellent
Thank you.
presentation.